Hey there, ready to jazz up your office, store, warehouse, or factory space? Well, buckle up because here's the inside scoop. If you decide to spruce up the interior and it qualifies as Qualified Improvement Property (QIP), you're in for some serious perks. So what's the deal with QIP? It's basically any cool upgrade you make inside your non-residential building. Think stylish offices, trendy stores, or super efficient factories after the building's initial service date. But here's the catch. QIP doesn't cover costs for expanding the building, adding elevators or escalators, or messing with the building's internal structure. So go ahead and give your space a facelift. It's time to make your workplace shine. Back before the Tax Reform Act of 1986, commercial real estate owners had it made. You could depreciate your property for over 15 years with the straight line method. No recapture worries. It felt like winning the lottery, turning depreciation into capital gain when you sold. But fast forward to today, and the game has changed. The once carefree building might now depreciation recapture tax when you sell. Yup, times have shifted. And here's the kicker. That not-so-friendly recapture vibe also applies to our buddy QIP. So consider this a heads up. Watch out for recapture, both of your building and those fancy interior upgrades. We've got to stay sharp in this ever-evolving tax landscape. Let's talk about Qualified Improvement Property. QIP offers three parts to deductions. First off, there's straight line depreciation, taking your expenses over 15 years per the IRS table. It's steady and reliable. If speed is what you need, there's Section 179 expensing, a fast track to writing off QIP costs. And then there's bonus depreciation, also known as additional first-year depreciation, giving you a big deduction boost. But watch out, when it hits 100%, it takes the spotlight, using up all your QIP bases. While you can mix and match the first two methods, 100% bonus depreciation stands alone, leaving no room for other deductions. It's a deduction superstar. Ever heard the joke about government help? Well, Qualified Improvement Property QIP is like that cool friend who actually comes through. It offers 3 quick paths to deductions, much faster than the traditional 39-year-old route. But there's a catch. Passive loss rules could throw a wrench into your plans, especially for rental real estate. You might have to defer some or all of your QIP deductions to the future. But let's stay positive. Assuming you can deduct all your real estate expenses, let's dive into the fun stuff, exploring each of these deduction choices. Moving towards bonus depreciation. Bonus depreciation offers an immediate deduction whether it's 60%, 80%, or the full 100%. Why opt for bonus depreciation? You can deduct the entire amount in the year you put the QIP into service. But watch out for passive loss rules, as they might limit your QIP bonus depreciation deduction. And when you sell the building containing the QIP you claim first-year bonus depreciation for, the gain can get tricky. It's considered additional depreciation for Section 1250 purposes, with an excess over the straight-line depreciation tagged as high-tax ordinary income recapture. For instance, if you used 100% bonus depreciation to claim $120,000 in QIP deductions, when you sell the property, you'll face taxes on $24,000 of straight-line depreciation under Section 1250 rules and $96,000, the excess of $120,000, minus $24,000 at ordinary income rates. Here's the key takeaway. While bonus depreciation offers immediate benefits, be prepared for tax implication when closing the property chapter. Let's dive into Section 179 expensing in the context of selling Qualified Improvement Property QIP. Brace yourself for some tax twists. Imagine you spruce up your commercial property with $120,000 of qualified improvements and cleverly claim it all as a section of 179 deduction. Fast forward 4 years, you decide to sell the property. When you allocate $120,000 of the sales proceeds to the QIP, here's the catch. You're facing $120,000 in high tax Section 1245 ordinary income recapture. Here's the deal. You deduct the full $120,000 initially, but when you sell, you'll owe taxes on that same $120,000. It might feel like a tax seesaw, but there's a silver lining. Think of it as benefiting from the time value of money, assuming you put those Section 179 tax savings to work for you along the way. It's like a financial dance where timing is everything. Let's take the straightforward approach. If you choose straight-line depreciation for your real property, including Qualified Improvement Property (QIP), and skip first-year Section 179 deductions and bonus depreciation, here's the upside. No worries about Section 1245 or Section 1250 ordinary income recapture. In this scenario, your only tax concern is unrecaptured Section 1250 gain from depreciation. And the best part? This gain is taxed at a federal rate of no more than 25%. It's like the tax world is smoothing things out for you. a simpler ride without the complexities of recapture. So if simplicity and a capped federal tax rate sound appealing, straight line depreciation might just be the way to go. Unrecaptured Section 1250 gain is a bit of a kinder tax sale compared to its counterparts, Sections 1245 and 1250 recaptures. Unlike its counterparts, unrecaptured Section 1250 gain doesn't always face ordinary income tax rates for individual taxpayers, nor does it fit into the same category as Section 1231 long-term capital gains. Here's the twist. Unrecaptured Section 1250 gain has its own spotlight, taxed at a flat 25% federal rate. Let's illustrate with examples. Example 1. If you're a joint filing individual with a 2024 taxable income of $355,000, mostly from an unrecaptured Section 1250 gain, and your ordinary income rates are below 25%, the flat 25% rate doesn't apply. Example 2. Now, if you're an unmarried single filer with a $200,000 taxable income about to add a $355,000 unrecaptured Section 1250 gain from selling a rental property, the flat 25% rate applies since your ordinary income rates on the additional $355,000 income would be higher than 25%. Here's a cool feature. You can offset this unrecaptured Section 1250 gain with any Section 1231 loss incurred in the same year. Plus, you can use any capital loss, carryover, and net capital loss from that year to further offset the unrecaptured gain. These capital losses take precedence before offsetting the other capital gains. It's like a strategic dance of numbers to minimize the impact on your wallet. Guys, planning for qualified improvement property QIP deductions can be a roller coaster ride. Whether you go for an immediate deduction or spread it out, there's a twist when you sell. The sweet deduction becomes taxable income, not the happiest ending. It's ironic compared to the old days when depreciation deductions turned into capital gains. Times sure have changed. So what's the game plan? If you're after that big first-year deduction, go for it. But watch out for passive loss rules that might delay or deny your deduction. And don't forget to consider the year you plan to sell your property. It's all about navigating the twists and turns of the tax landscape. Don't forget about the 3.8% net investment income tax, NIIT. If you have depreciable qualified improvement property QIP, you might face an extra 3.8% NIIT. It applies to gains like Section 1240 recapture, Section 1245 recapture, unrecaptured Section 1250 gains, and Section 1231 gains. This NIIT can catch you off guard, so stay prepared. Check out How to Beat and Mitigate the Net Investment Income Tax NIIT for tips. It's like a map through the tax maze. Watch out for the 3.8% net investment income tax NIIT, which can sneak in and add an extra hit, especially on QIP recaptures. You have options with QIP depreciation, grab deductions and depreciation to ease current year taxes or skip them to potentially lower the tax bill when you sell. It's like a tax strategy game. Choose your moves wisely for your wallet now and in the future. Goodbye.